textbook chapters on debt and equity are excellent, but I wanted to introduce the concepts to you because, frankly, a lot of people don't understand what you mean when you talk about the differences between debt and equity. Most of you have had personal experience with debt. If you've used a charge card, then you know what it is because technically you're indebted to the credit card company. And if you don't pay your bill that month, they charge you interest. So you had car loans, home loans, and the like, so you're familiar with debt. But here's the principle of debt, is that you have formed a contract and that you will pay exactly on the terms that are agreed to. And that's key, because what we will not do if we are the person who takes out the loan is we will not pay more. In other words, we won't go to the bank and say, you know, you trusted in me, you gave me the loan for my startup when nobody else would. We agreed that I was going to pay you 10% interest for 5 years. I'm a big success, things are going great. I'm going to pay you 20% interest. It doesn't happen that way. Because of that, the top end of the bank is limited. They won't make any more than the terms of the deal. Because of that, they can't afford to make any less. And the way to think about that is they can't participate in the upside of a huge success. So they also, likewise, cannot participate in the downside of a big failure. And in my undergraduate class, I go through an elaborate exercise and I prove to them that at the price banks charge, they don't have the room to take losses. Because banks don't have the room to take losses, they become very conservative toward investing in startups. So you can see in this chart out of another textbook, when it talks about the various types of debt financing, one of the things the textbook I'm having you use does a great job with is it points out how trade credit is a form of debt, and that's what's typically available to startups. But if you look, most of the other traditional forms of debt, to include banks, are not forms for startups. And that's not because banks or these other forms are bad people. It's that since they can't participate in your upside if you do really well, they have limited room to participate in your downside. Here's the one caveat to what participating in the downside, and that is if you can collateralize the loan. Since the bank can't afford to lose money, they're going to want to see that they can quickly, if you default on the payments, that they can quickly recapture your money. And that's why when you look at all these potential sources or of what's bankable, you notice none of them say 100%. Because the bank isn't going to say, well, I loaned you $1 million to build a building, you built the building, it's worth $1 million, I'm good with that. No, they're going to want to say if that building costs $1 million, I'm willing to loan you $500,000, but I will have the building as a collateralized asset so that if you default on the loan, I can go in and I don't have to sell the building for $1 million. I only have to sell it for $500,000 and I've got my money back. And you're going to find that's what banks tend to do. If they have to take property back, they're not trying to make money on the sale of it so much as they're trying to quickly sell it to get their money back. So that's why when you look at all these things, you don't see 100%. So you go to a bank and you say, oh, I need $100,000 to start this business. It's a non-starter for them unless you have personal assets that you can back up the loan with. And that's where you hear about entrepreneurs using their house, their cars, their 401ks, everything they can to try to make that work. So now let's shift from debt to equity. Fundamentally, an equity investor has a different approach than the bank. The equity investor knows they're taking a huge risk, that the possibility of complete loss is substantial. But that's okay because I'm expecting you to return my investment many-fold. We're not talking 10% interest. We're talking 30, 40, 50, 60, 70, 80% annual return, not total return, annual return. Because I have a great chance of failure, and I'll explain that to you in just a second. Also, remember what you're doing in equity is fundamentally different than debt. Debt is, I'm borrowing money from you, I'm usually collateralizing it with some device, and I'm agreeing to pay you this money back. Equity, completely different. Equity says, I, the entrepreneur, are selling you a chunk of my company, giving it to you, Mr. or Mrs. Investor, in return for cash. So in essence, an investor is a part owner of the business because they own a chunk of the business. Because the downside is immense, they are looking for immense upsides. And let me put it to you this way. when it comes to investing in startups, particularly venture capitalists, this is a good way to explain it. Investing in startups is like hiring a slugger in Major League Baseball. This name has been discredited with the steroid issue, but he's a famous slugger, Barry Bonds. So for every 10 times Barry Bonds steps to the plate, what happens? 3 or 4 times Barry Bonds strikes out, or I should say struck out because it's historical, because his job is to swing for the fences. He's trying to hit a home run every time he comes to the bat. So 3 or 4 times, it's a complete loss. He strikes out, walks back to the dugout with his bat dragging. Sorry, coach, or sorry, sorry, coach, I didn't make it happen. A few times, 1, 2, maybe, Barry will hit the ball and it will go in play, but it will result in an out. It may advance a runner, which isn't altogether bad. Barry may get on base when somebody else gets thrown out. So it's kind of like I didn't make money, but I didn't lose money. Something semi-good happened in a court, also with something semi-bad. Then another 2 or 3 times, something kind of good happens. The pitcher walks Barry. Barry gets a single. So it wasn't bad, but it wasn't what I hired Barry Bonds for. I hired Barry Bonds to be a slugger. Likewise, and then 2 or 3 times, literally, Barry Bonds hits a double or triple or home run, preferably a triple or a home run. That's what I hired them to do. That's a slugger. And you know what? That's exactly what the typical equity investor venture portfolio looks like. Even professional investors like venture capitalists, a good 30 to 40% of their deals on average become total losses. They invest $1 million, they get nothing back, complete loss. They have a handful of investments where things aren't a complete loss. They might get back $1 million on their $1 million, they might get back $800,000 on their $1 million. So it's not a complete loss, but it wasn't very good either. Then they'll have others that will do okay. So now maybe they're making 8, 10, 12, 15% as an annual return. So this is like my single or my walk. Not what I hired him for, but not a bad outcome. But then I have those 2 or 3 home runs or extra base hits where my returns are 60, 70, 80, 90% annually. And those pay for all of those other deals. And that's what it's like an equity investor. I can afford the risk of a 0 because I have the huge upside risk. So where do you find these? One are the business angels. You'll hear me talk a lot about angels through the course because I work with an angel group. I basically run an angel group here in Wichita Falls. Then you hear a lot in the press about venture capitalists. And venture capitalists is an interesting thing because a VC is a person who thinks they're really good at investing in startups. They go out and they raise money from a bunch of other people, which they then put into these various investments to make money. So VCs are people who think they know better than anybody else who to invest in, and they use other people's money to do it. And like I said, they'll tell you right up front, we're gonna strike out a good chunk of the time. We're gonna have investments that are gonna be total losses, but one Facebook, one Instagram, one Oculus Rift can pay for a lot of mistakes. Equity investment in the United States is a relatively recent phenomenon. I'm talking 20, 30 years. Angel investing has really blossomed in the past 15 years. Here's the way to look at it. Angels invest in a lot more deals, but at lower dollar amounts. VCs invest in relatively few deals, but at higher dollar amounts. But you can see from the graphic on the bottom of the slide, we're talking serious money. So I hope this sets the stage for you as you go into the textbook readings to talk more in more detail about debt and equity.